and welcome to our news video. Subscribe to our channel and share your comments so that you don't miss any important news. The Cryptocurrency News End channel does not recommend any offers to buy, sell, invest, etc. in the cryptocurrency market in any way, and any losses and other consequences are your responsibility. Our channel only follows the news of the cryptocurrency market and does not provide you with any advice on making transactions. Please enter into transactions in the market with your own analysis. Bitcoin in free fall. Market panic as BTC crashes below $80,000. Is $70,000 next? Bitcoin price in free fall. Will BTC crash below $70,000 as market panic spreads? Bybit hack triggers institutional panic. Will Ethereum staking survive? Metaplanet doubles down on Bitcoin. $13.4 million bond issuance signals aggressive accumulation amid market volatility. Brutal 20% Ethereum price sell-off is not over. But is there a silver lining for ETH? Bitcoin in free fall. Market panic as BTC crashes below $80,000. Is $70,000 next? Bitcoin has plunged below the critical $80,000 mark for the first time in over 3 months, triggering widespread panic across the crypto market. As fears mount over U.S. President Donald Trump's proposed tariffs and their economic consequences, traders brace for further declines. Bitcoin breaks below $80,000 amid economic uncertainty. On February 27th, Bitcoin, BTC, dropped to $79,752, marking a shocking downturn that erased nearly all gains made since Trump's election victory in November. According to TradingView data, this sudden 2.65% price dip within an hour led to over $100 million in liquidated long positions, per CoinGlass. Bitcoin's collapse below $80,000 has reignited fear among investors, particularly as traders now fear an imminent crash to $70,000 or lower. Many had previously pegged $82,000 as a strong support level, but BTC has shattered expectations. Is a $70,000 Bitcoin inevitable? Analysts weigh in. Market analysts warn that Bitcoin's current trajectory mirrors previous cycles, where steep declines preceded major recoveries. Popular crypto trader DMAC issued a grim forecast on X, stating, "Dip buyers are getting smoked. I still see $70,000 as the target." Crypto trader Mandrick echoed similar concerns, adding, "If you liked Bitcoin at $80,000, you're going to love it at $70,000. Meanwhile, pseudonymous analyst Rager attempted to calm nerves, suggesting that Bitcoin's drop to mid or low $70,000 would still be within historical norms. Even in previous bull markets, Bitcoin has faced corrections of 30 to 40% before surging to new highs. Despite Bitcoin's dramatic plunge, some investors are still holding strong, believing that this is just a temporary pullback in a larger bullish cycle. Institutional players remain bullish despite bloodbath. While retail traders panic, institutions continue to hold their ground. Standard Chartered's head of digital asset research, Jeffrey Kendrick, remains extremely bullish on Bitcoin. On February 27th, he doubled down on his prediction that Bitcoin could hit $200,000 by the end of 2025 before reaching an astronomical $500,000 before the end of Trump's second term. However, the short-term outlook remains uncertain, with crypto predictions platform Polymarket showing a near 50-50 split among traders on whether Bitcoin will recover or plummet towards $70,000 in the coming weeks. Bitcoin's future hinges on key support levels. At the moment, Bitcoin's price action suggests two possible outcomes. A recovery above $80,000. If Bitcoin manages to reclaim $82,000 as support, it could signal renewed strength and a move back toward $90,000. A further collapse to $70,000. If bearish sentiment prevails and panic selling accelerates, Bitcoin could revisit the $70,000 level for the first time since November. The biggest question remains: will Bitcoin survive this brutal correction and rally to new all-time highs, or is this the start of a prolonged bear market? Bitcoin price in freefall. Will BTC crash below $70,000 as market panic spreads? Bitcoin's price has taken a severe hit this week, plunging 10% in the past 7 days. With BTC breaching the critical $85,000 support level, the cryptocurrency faces the risk of a deeper correction, sparking fears of an extended bear phase. Bitcoin plummets. How low can it go? As of February 27th, Bitcoin, BTC, has dropped 3% in the last 24 hours and a staggering 10% over the past week, fueling concerns among investors. The price slump has led to renewed speculation among traders, with many eyeing a possible drop below $80,000. One key metric that has caught analysts' attention is the Chicago Mercantile Exchange, CME, gap, which suggests Bitcoin might be heading towards $78,000. This looming technical pattern could determine Bitcoin's next major move. But how deep could the correction go? The Bitcoin CME gap, a dangerous indicator? The CME Bitcoin futures market, a key player in institutional trading, has historically seen its gaps act as strong price magnets. These gaps occur due to the CME's limited trading hours, unlike the 24/7 crypto market, leading to price discrepancies when Bitcoin opens at a different level than its previous close. Currently, a critical gap exists between $77,930 and $80,670. Given Bitcoin's historical tendency to revisit and fill these gaps, traders now anticipate a potential return to this level before any sustained recovery takes place. Looking back, previous CME gaps, such as those at $9,700 in 2020 and $35,000 in 2021, were eventually filled, often during periods of high volatility and market corrections. If history repeats, Bitcoin may be on the verge of a painful drop before any potential rebound. Will Bitcoin crash below $73,000? Some analysts warn that if Bitcoin fails to hold the CME gap level, it could trigger a cascade of liquidations, pushing BTC down toward March 2024's all-time high of $73,000, or even lower. Renowned crypto analyst Alpha BTC warned in a February 25th X post. Bitcoin is holding on for dear life after losing the $85,000 support level. If BTC doesn't hold above $77,000, we could see a move down to the March highs around $73,000. This analysis aligns with market fears that Bitcoin's recent rally, driven by institutional adoption and political developments, may be losing steam. The latest sell-off is now erasing some of the gains from the so-called Trump pump following Donald Trump's election victory. Key levels to watch. Could Bitcoin drop to $52,000? Top analysts are now watching several crucial price levels that could dictate Bitcoin's fate. $72,000 support zone, established during Bitcoin's November 2024 rally, This level is a psychological barrier for traders. $65,000 critical level. Losing this support could open the floodgates for an even sharper drop. $58,000 to $60,000 demand zone. This range serves as a major accumulation zone, but if broken, could lead to a deeper collapse. $52,000 ultimate support. If BTC falls below this level, it could spell disaster for the market, triggering panic selling and widespread liquidations. Meanwhile, data from CoinGlass indicates that a massive amount of liquidity is building in the lower $70,000 range, which could act as a magnet pulling prices downward in the short term. Institutions still bullish, but will it be enough? Despite Bitcoin's recent volatility, institutional players remain optimistic about the long-term trajectory. On February 27th, Standard Chartered's head of digital assets research, Jeffrey Kendrick, reaffirmed his bullish stance, stating, "Bitcoin's price is still on track to hit $200,000 by year-end, with a potential rally to $500,000 before Trump's second term ends." However, with panic spreading across retail traders and Bitcoin struggling to find stable support, could these optimistic predictions hold, or is a deeper crash inevitable? Is Bitcoin headed for a catastrophic collapse below $70,000? With Bitcoin hanging on the edge of critical support levels, uncertainty dominates the market. Will BTC recover and resume its bullish trajectory, or are we witnessing the start of a prolonged bear market? Bybit hack triggers institutional panic. Will Ethereum staking survive? The recent Bybit hack has sent shockwaves through the crypto community, shaking investor confidence and putting institutional Ethereum staking in jeopardy. With over $1.4 billion in liquid staked ETH stolen, the scale of the attack is unprecedented, sparking fears of further breaches and regulatory crackdowns. Institutional investors rethink Ethereum staking amid security concerns. Cryptocurrency staking services have long been viewed as a lucrative avenue for investors seeking passive income. However, Bogdan Aprishko, chief operating officer of Everstake, warns that high-profile cybersecurity breaches such as the Bybit hack are pushing institutional players away from staking. When an auditor or institutional investor evaluates an ETH exchange-traded fund, ETF, and sees a billion-dollar hack, their legal and compliance teams are likely to freeze any plans to allocate funds into such assets, Aprishko told Cointelegraph. The North Korean Lazarus Group executed the attack on February 21st, exploiting Bybit's wallet vulnerabilities. This breach, the largest in crypto history, has exacerbated fears of centralized exchange (CX) security failures. Exodus from centralized staking, a mass migration to safer alternatives. The fallout from the Bybit hack has accelerated a growing trend: the decline of staked ETH on centralized exchanges. Over the past 6 months, the amount of staked ETH on CXs has plummeted by nearly 7%, from 8.6 million ETH in September to just 8 million in February. Immediately following the hack, staked ETH fell by another 0.5% as users scrambled to move their funds to non-custodial solutions and hardware wallets. Users increasingly withdraw their staked assets from CXs, possibly moving them to non-custodial staking solutions or hardware wallets for better security, Aprishko noted. With institutional skepticism rising, the future of Ethereum staking could be at a crossroads. Will investors turn to decentralized staking solutions, or will regulatory intervention make staking more restrictive? US versus Europe. The future of Ether ETFs and staking regulations. While Ether ETFs in the United States currently do not permit staking, the Securities and Exchange Commission, SEC, has recently acknowledged requests from issuers, including 21 shares, to allow a portion of ETF holdings to be staked. In contrast, Europe already permits staking for Ether ETFs, further highlighting the regulatory divergence between the two regions. As of February 27th, Ethereum ETFs have attracted nearly $3 billion in net inflows since their launch in July. However, they continue to lag significantly behind Bitcoin ETFs, which have spearheaded institutional crypto adoption with over $37 billion in net inflows since January 2024, according to data from Farsight Investors. The regulatory landscape is crucial in determining whether Ethereum staking can regain investor trust. If U.S. regulators approve staking for Ether ETFs, it could open doors for institutional capital, potentially reversing the bearish sentiment triggered by the Bybit hack. The bigger picture: how safe is crypto staking? Ethereum staking offers an attractive yield through network fees and rewards, but it also carries risks such as slashing, a penalty that can result in the loss of staked assets if a validator misbehaves. The Bybit hack has intensified concerns over the security of staking mechanisms, with some analysts predicting stricter oversight in the near future. Beyond Ethereum, other blockchain networks such as Solana also offer staking mechanisms. While Solana has seen rapid growth in decentralized finance, DeFi, adoption, its ecosystem has also been targeted by exploits and rug pulls, raising further questions about the sustainability of staking across different networks. With cybersecurity threats looming and regulators tightening their grip on crypto staking, will institutional investors continue to embrace Ethereum staking, or are we witnessing the beginning of a major industry shift? Metaplanet doubles down on Bitcoin. $13.4 million bond issuance signals aggressive accumulation amid market volatility. Metaplanet, the Japanese Bitcoin treasury firm, has once again made headlines by issuing $13.4 million in 0% bonds to expand its BTC holdings, reinforcing its aggressive accumulation strategy despite looming market uncertainties. This move comes as institutional investors watch the volatile crypto landscape with caution, wondering if Bitcoin's current dip presents an unprecedented opportunity or a looming disaster. Metaplanet's billion-yen bet on Bitcoin. In a bold financial maneuver, Metaplanet issued 2 billion Japanese yen, $13.35 million, worth of bonds on February 27, 2025, to fund additional Bitcoin acquisitions. This marks the company's seventh bond issuance dedicated exclusively to BTC purchases. The latest round of 0% ordinary bonds comprises 40 units, each with a face value of 50 million yen. Notably, these bonds bear no interest and are set for full redemption on August 26, 2025. The proceeds from the issuance will be funneled into Evo Fund, Metaplanet's Bitcoin acquisition vehicle, further cementing its commitment to cryptocurrency accumulation. A relentless Bitcoin accumulation spree. Since May 13, 2024, Metaplanet has executed 17 Bitcoin acquisitions, with its largest single purchase occurring on December 20, 2024, when it secured 619.7 BTC. This consistent buying spree has propelled the firm's total Bitcoin reserves to 2,235 BTC, currently valued at approximately $192.4 million. Founded in 1999, Metaplanet was historically known for its ventures in real estate and business investments. However, its pivot toward Bitcoin since 2024 has drawn stark comparisons to US-based MicroStrategy, the Michael Saylor-led software company that pioneered corporate Bitcoin treasury investments. Like MicroStrategy, Metaplanet appears to be leveraging a high-risk, high-reward strategy by converting traditional assets into BTC amidst uncertain macroeconomic conditions. Stock market reaction, meteoric rise, and pullback. Metaplanet's aggressive Bitcoin acquisitions have had a profound impact on its stock price, which soared from 200 yen to a staggering 6,650 yen in early 2025, a 3,225% surge within less than a year. However, recent market corrections have led to a pullback, with the stock currently trading at around 4,000 yen. Despite the volatility, Metaplanet remains undeterred. In February, the company unveiled its ambitious roadmap to acquire 10,000 BTC by Q4 2025, with a long-term goal of amassing 21,000 BTC by the end of 2026, an amount that would be worth over $2 billion at current market prices. This strategy indicates Metaplanet's belief in Bitcoin as a long-term store of value and hedge against fiat currency devaluation, institutional fears, and market speculation. Is Metaplanet taking an unprecedented risk? While some investors hail Metaplanet's strategy as visionary, skeptics warn of potential risks associated with heavy Bitcoin exposure. The cryptocurrency market remains highly unpredictable, with Bitcoin experiencing dramatic price swings in response to global economic events, regulatory shifts, and institutional sentiment. With Metaplanet doubling down on BTC despite market volatility, the pressing question remains: is this bold Bitcoin strategy a masterstroke that will redefine corporate treasury management, or is it a dangerous gamble that could lead to financial catastrophe? Brutal 20% Ethereum price sell-off is not over, but is there a silver lining for ETH? Ethereum's price has suffered a severe 20% correction, leaving investors on edge as market volatility continues to dominate. With ETH struggling to reclaim key support levels, many fear that the worst is yet to come. However, shifting investor behavior and stabilizing derivatives markets may offer a glimmer of hope for Ethereum's future price trajectory. Ethereum's 20% drop sparks panic. Is recovery possible? After plunging from $2,800 to $2,255 in just 3 days, Ethereum has struggled to regain its footing. Market sentiment remains fragile as traders assess whether ETH has hit rock bottom or if another leg down is imminent. While some indicators suggest that a rebound to $2,800 is within reach, macroeconomic conditions and investor caution could delay any significant recovery. The ETH futures market is showing tentative signs of strength, with the 30-day ETH futures premium rising to 7%, a slight improvement from 6% just 2 days prior. Typically, a premium between 5% and 10% is considered neutral, suggesting that bearish momentum may be losing steam. Still, breaking past the $2,600 resistance level remains a formidable challenge. Macroeconomic uncertainty weighs on Ethereum's price outlook. The broader economic landscape presents significant hurdles for Ethereum's recovery. Recent U.S. labor market data has added to investor uncertainty, with jobless claims reaching 242,000, the highest in 3 months. Meanwhile, pending home sales plummeted 4.6% in January, significantly worse than economists' forecasts of a 1.3% decline. Adding to market jitters, geopolitical tensions and trade wars continue to stoke fears. U.S. President Donald Trump's proposed tariffs on Chinese, Canadian, and Mexican imports, along with threats of a 25% tariff on European goods, have triggered warnings from global trade leaders. The European Union has vowed swift retaliation, increasing fears of an escalating trade war that could negatively impact risk assets like Ethereum. Even traditional safe haven assets have felt the pressure. Nvidia's stock plunged 3.3% despite outperforming earnings estimates, while gold prices dropped 2.2% in just 2 days, hitting a 2-week low of $2,870. The broader market sell-off raises concerns that investors may continue to exit crypto in favor of cash holdings. Ethereum derivatives show resilience amid market chaos. Despite the brutal price drop, ETH options markets are signaling resilience. The Ethereum options skew remains at -2%, well within the neutral range of -6% to 6%, indicating that institutional traders and whales are not panic selling. This is a stark contrast to previous crashes, where extreme fear led to a sharp rise in put option demand. A similar scenario unfolded on February 3rd, when Ethereum's price collapsed 38% within 3 days, plummeting from $3,437 to $2,124. Yet, the ETH delta skew metric remained stable, reflecting continued confidence in Ethereum's long-term fundamentals. Ethereum recovered to $2,750 within a day and maintained the $2,550 support level for 2 weeks, suggesting that a similar bounce could occur if market sentiment stabilizes. Ethereum's path to $2,800. A matter of time? Ethereum's price recovery will likely hinge on its ability to maintain dominance in decentralized finance, DeFi, and staking. While Solana's momentum in the memecoin sector has waned, Ethereum continues to lead in total value locked, TVL, driven by strong demand for liquid staking solutions, lending platforms, yield aggregators, and automated liquidity protocols. For ETH to reclaim $2,800 and beyond, Ethereum's upcoming network upgrades must drive greater adoption and incentivize Layer 2 development. By strengthening staking rewards and expanding utility, Ethereum can attract long-term investors and developers, paving the way for sustained price growth. Could Ethereum's sell-off get even worse before a recovery begins?